Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome everybody, let's take a look again on the gold market. So here we're starting from the weekly chart because on the weekly chart we have most important pattern to us. As you remember from our discussion last week, it is bullish grabber. And I intentionally show you the futures chart. So this is not the retail broker chart where some mistakes might be, but this is official from the Chicago Mercantile Exchange, from the Commodity Exchange, the chart of the gold futures. So this is continuing futures weekly chart, and the same pattern you could find in the February contract. So we have the and in December probably as well. So here we have the bullish grabber, but from the technical point of view, this is just perfect and nice, and at the same time it should be simple to trade it. You just need to take the bet and place the stop below the grabber. That's what the technical framework needs to suggest to do. But at the same time, on the background of the possible action here stands the Fed meeting. So today I think that we prepared very important weekly report, because there we have taken a look not just on short-term perspective and on the Fed meeting and in what circumstances gold could move higher or lower depending on what Fed will tell. We also have taken a look at the longer-term United States strategy on the global economic domination. And in today's report, we have provided few results, fruits of the recent United States efforts to make the pressure, economic pressure on China. Now we see that this strategy indeed starts to work. With the term of the following of the strategy, we suggest that it should last at least for more 2-3 years, and it's very probable that pandemic will stand with us for this term. So hardly something will change within a couple of years. It's definitely. As United States suggests, I suppose that this term is enough to trigger some chain reaction in the Chinese economy. That could lead for real big problems in the economy and stop the fast growth of the Chinese economy, which led the United States to dominate in the global economy as well. So why we are talking about this? It's just because it tells us concern about inflation. So this, since current inflation is mostly artificial, and it's also the part of the same geopolitical struggle, with the 2-3 years more, it means that inflation hardly will get the relief within this term. If even the Fed will start rising rates, so inflation could stand. Just because the rising of the rate will not change the problem and will not reduce the problem of the goods supply. So, this is absolutely different inflation compared to what we had previously. And currently, since the Fed currently is not really very fast in the rate change, it means that within the year, the real interest rate probably will stand in the negative area, which suggests that gold should not show any significant collapse. So our view is that in the longer term, within the 1-2 years, gold should have significant support in the price action. We're not sure that definitely will be some rally, that market will move above the 2000 area, for example. But at least we should not get some significant drop in the gold. In the shorter term, yes, some volatility could appear. It's just because misbalances between the inflation activity of the Fed, rumors, expectations, and so on. But in the longer term, it will mostly depend on how fast Fed will catch up with the inflation. Once they will start to run ahead of it, real interest rate starts to rising and the gold starts falling. So in fact, you should not forget that major driving factor for the gold is the real interest rates. So they could start rising only by two reasons. Either Fed will start to accelerate or inflation starts to fall. Speaking on the latter, currently overall global situation doesn't suggest that. It means that all question stands around the Fed policy, how fast Fed will change the rate. And currently it seems that they are not really very rushing to do this, which should provide support to gold. So this is what's about the long term, and lots of other interesting stuff you could read today. Speaking on the shorter term, returning back to this grabber, so as I said, it's mostly dependent on the Fed. In the shorter term, our suggestion is that gold could be hurt only if Fed will change the rhetoric. So we do not expect that Fed will change their promising to tapering of the bond buying program. It's because it's already mostly priced in, as well as the 2 rate increase in the next year. We think that this forecast Fed will hold without no changes. But what they will tell in the press conference, and if they will provide more hawkish tone with the assessment of the current economic conditions and inflation perspective, that could hurt the gold. So that could make some verbal intervention, support the dollar, and could hurt the gold. But as you could see, maybe this grabber, if we suggest that the technical picture somehow could forecast what fundamental background will be, it seems that market does not expect currently that this could happen. So maybe the tapering of the bond purchasing, acceleration with the tapering, will be enough currently at this stage. If this really will happen, and Fed remains mostly everything the same, just announce the acceleration of the tapering, that will be the bullish effect for the gold, because this acceleration is already priced in mostly. At the same time, the tricky moments currently exist around this pattern, and they are bearish. So if we'll take a look at the daily chart, I also will show you the futures, just because they have different shape. So once of the retail broker chart, we've got the grabber on Thursday. So if you remember, I have shown you this on the daily chart. This is FX choice chart. On the real futures, we've got the grabber on Friday, on the closing of the big short position on the gold, and actually this dollar longs position have been closed. While on the futures, as I said, we've got it right on Friday, and this is bearish and suggests taking out of these lows. If you remember, on the 4 time frame chart, we have targets that have not been completed yet, which is a COP, it's major ABCD pattern, and 3 drive pattern that's also not completed. On the Friday's performance, on the 4-hour time frame chart, we also have got 2 grabbers that also suggest downward action. So taking it all together, we suggest that currently on the Monday and on Tuesday, it would be better to not take any long position yet and wait when the bearish patterns that we have will be either completed with a downward drop or cancelled with an upward continuation. In this case, we could consider taking the long position with the weekly chart. The risk from the Fed is a separate question. Here, this choice is up to you. Would you like to trade it through the Fed statement, understanding the all risks that it carries? But speaking on the technical part, we need to exclude the risk of these bearish patterns that we have. For us, it will be perfect if market will drop back to the 1755, complete the 3 drive, providing us the bullish pattern, complete the ABCD here, the COP target, right at the major 618 support. And this will be perfect because in this case, as the bearish patterns will be completed, as the bullish pattern on the weekly chart still will have chance to succeed, supporting from the Fed flat statement. So that will be the perfect combination for us. How it reality will turn, we will see. But I will call you to think twice about taking the long position here, as because we have the bearish patterns that is not completed yet, is not cancelled, as because of the ordinary Fed risk that stands around any meeting that we're getting. So that's our current view on the gold market.